Hey everybody, this is Jose. We are about to get started. A few seconds and we go. As always, a sound check would be great. The way to do it, if you're new, is just to type hello on the chat box. That tells me that you hear me, and it's a nice thing to do, right? To say hello. So let's do that, and we get started in 20 seconds. Thank you so much. How are you, Joanne? It's good to see you. 10 seconds to go. Almost there. That's it. Top of the hour, time to get started, everybody. Welcome to the session. Today is November 3, 2022. My name is Jose Blasco. This is our options trading live session. And as the name suggests, we're going to be trading options. So we're going to be looking at the markets and doing a series of things. Before we get started, I would like to highlight our financial disclaimer on the upper left side of the screen. It's being highlighted one word at a time, so please read it carefully. It is important information. Counting on you guys to read it fully. Okay, it's again important stuff, so take your time, please. Joe, how are you? Good to see you. Jeff, how are you, my friend? It's nice to have you all here. So agenda for today, trading is all about being mechanical. So we're going to just follow a mechanical process throughout the session as well. We're going to be looking at the market, understand what's happening. We're going to be looking at trades that we already have in the accounts so we can manage them if anything needs to be done, which indeed it has to be done. So we will. And then finally, we'll focus on looking for new trading opportunities and find those. With all of this said, that's it. Let's get started. And I am now moving into top. And I would like to start looking at the VIX. So we can begin our market analysis looking at the level of volatility available in the market, which is currently 25.85, as you can see. And I guess that you would agree with me if I was to state that this is not too high, this is not too low, isn't it? Yeah, so it's a pretty fair value, to be honest, for volatility. If you were to look at the ranges, so it's a little bit on the bottom side, if you wish. I mean, depending on how much you zoom out, right? If I zoom out a bit more, it's kind of like exactly in the middle. If I zoom in a bit more, it's slightly below the midpoint. So definitely, I would prefer to be a buyer of options versus being a seller of options overall. Of course, there are opportunities to find stocks with high implied volatility themselves, for sure. But ideally, you would want to align the methodologies that you use on your individual securities to be in line with what's happening in the market overall. Just like when you buy a stock, you look at the S&P to find out what's happening in the broad markets, and you trade the stock in that direction. Same with the VIX, even though it's okay to be less precise with the VIX compared to market timing about when to enter and when to exit trades, given the fact that each stock got volatility figures which could vary a lot from one stock to another. Okay, so but it's always a good reference, okay, to kind of stack odds in our favor as we start getting organized. So volatility, kind of in the middle. I could be a buyer, I could be a seller, not a major preference. A little bit of a preference to be a buyer just because it's a little bit below the mean, even though it's it's not that low either. So if I was to find opportunities to be a buyer of options, then I would turn around and be happy to be a seller. But priority or step one will be looking for buy opportunities later when I look at opportunities themselves. When I say buy opportunities, I mean buying of options, okay, which is not necessarily being bullish. Maybe we buy puts and we make ourselves bearish, okay, but being a buyer of premium seems to make a lot of sense based on the market analysis I just did on the VIX. Mark, it's good to see you, my friend Ahmed. Very nice to have you with us as well. Very nice. So now I switch, and we are now looking at the SPY. And when looking at the SPY, we can see that in the past few days, actually yesterday, we had a change of climate. The climate has changed, and not only it has changed, as you can see, it's a thick dot. Okay, so we have a down climate, which is confirmed. The up climate expanded, more or less normally based on what statistics we have suggested, which is 5. So we got a duration of 1, 2, 3, 4, 5, 6, 7, 8. So a little more, okay? I'm not surprised because when we look at the implied volatility of the calls blue line versus the implied volatility of the puts gray line, even today, where the climate is down, we have buyers in the market. Okay, so given the fact that we have buyers in the market, I'm not surprised the blue climate extended by a little bit extra. But of course, we surpassed 5 by a lot. So putting on the side that yesterday was FOMC meeting, and of course the news was quite a big news, even though I guess it was expected by everybody. It's just probably smart traders took profits, and now they're waiting to buy lower, and that's why the market has been falling. Again, statistics kind of like would have suggested this to be smart as a decision. But again, we have buyers in the market right now. Okay, blue line above the gray. So what we are dealing with today is one of those contradictions that I mentioned in the past, where in a way we have autoclimate telling us that being a seller carries with it a statistical advantage. That would imply catching moves of 3 days on the way down, so short moves on the way down, and that makes a lot of sense. But at the same time, having buyers in the market, we could see things like that, where we only have one red dot and then it goes back blue. Okay, so we may see a sharp turning point and the market go back up. So so far, if we have to enter a trade today, my preferred approach, and you have seen me do that in the past, would be to look for non-directional opportunities. Why? Because we have a contradiction where the climate is telling us to be a seller, or climate is not telling us anything. It's just representing that we have odds in our favor. There is a statistical advantage by being a seller versus being a buyer. But at the same time, we have buyers in the market, so we should not expect the market to fall too deep. In that sense, reward to risk ratios may not be that favorable, and in that sense, I prefer to do non-directional trading. Of course, the moment the climate goes back up and we are back to move higher, and we are back to have a blue dot, okay, then the approach will be exactly the same approach I mentioned in the prior week, which is blue and blue, right? So buyers in the market and the climate confirming that situation, that would be a pretty nice environment for us to look at opportunities which imply to be buyers. Even aggressively, I would say it's fine. Based on my trading plan, it would be fine for me to be aggressive as a buyer and find high delta trading opportunities, so I can catch those moves to the upside and profit heavily from those. Okay, so that would be the approach. But we're in a down climate, so again, contradiction. Therefore, my cautious approach to it would be to exploit non-directional trading until we have that confirmation. For the ones of you a bit more daring, for sure, it's a down climate, you could be shorting, but I would even suggest that instead of doing that in a daily time frame, maybe a lower time frame, and catch day trades to the downside, something like that. That would make a lot of sense. But again, statistically speaking, this market is supposed to fall by 3 candles at a time, and given the fact that we have buyers in the market at this moment in time, blue above the gray, so we should expect that statistics to be met, or maybe it's only 2 days going down and then it goes back up, right? Because we got buyers in the market. So, again, I don't want to position myself strongly as a short seller, unless you are hedging a portfolio, which this is a different story, okay? Anyway, so if you could confirm to me on the chat box that the market analysis I just completed is well understood, that would be great. If you have questions, this will be the great time as well for you to mention and ask. Because I am about to now get into trades, review what we have, and find new trades. And I would like to make sure everybody's with me with the market analysis. I'm going to take a look at the chat box. Joanne, next Monday, if anyone is interested, I'm doing ninja session in Traders Room 1 hour after the market opens, beginners use session. Wonderful, Joanne. And yes, for the ones of you that maybe were not aware, or maybe were not here last week when Joanne mentioned it for the first time, and as you probably all know, on our website, if you scroll down all the way to the bottom, there is a traders meeting room link, right? And everyone could get in there. It's an open room where anyone, just by typing your name, you can just enter the room and meet with other people. So Joanne is planning to be there next Monday during 1 hour after the market opens to go over the use of Ninja Traders. So if you were not aware, now you are. And you don't want to miss Joanne. So I very, very much recommended that you guys are part of that session if you have the time. Cool. Thank you so much. Okay, so great for those confirmations on the chat box. So let's take a look at positions. Okay, so what do we have when it comes to positions? So Amazon was a double calendar. Give me a second, guys. Thank you. Sorry for that. I had to take a sip of water. So Amazon is a trade that was a double calendar that then was converted into a double diagonal right into earnings. And if we look at the chart of Amazon, and I move to the daily time exactly. So earnings took place on that particular day, okay, on the 27th, and the 30, the 28th. 27 on the 27th, and then the 28th was Friday. So notice that on Friday, Amazon closed here. That was last Friday, and this is Thursday, which is the last time we met. So in other words, Amazon closed way below our 121 strike, and therefore this trade made the maximum profit, which I do not recall how much it was. I think it was close to $200 per contract, something like that, if I'm not mistaken, or maybe a bit more. But anyway, the bottom line is that the trade is over, and the trade achieved its maximum profit after entering this trade on this particular date at the beginning of September, where we spent that month preparing, massaging the trade into the earnings date by rolling calls and puts every week until we got to a point where the double calendar was then moved into a double diagonal position, and then, autopilot, if you wish, nothing to do, and let the earnings happen. Ideally, you have a big gap. In this case, it happened, and therefore that kind of guaranteed the maximum profit, and that's what we got. So that's it. Amazon is done. I'm just gonna delete it, but before I do, if you could confirm on the chat box that all good with Amazon. So if you could confirm if you took the trade or you didn't, if you could confirm if you have any additional question or anything, please let me know. But that's it. This trade is over, so I'll be deleting this from my positions panel in just a moment. The next trade is PayPal, which was also concluded last Friday on October 28th. So I'm just reviewing this very quickly. Very little to say about PayPal, to be honest. I will zoom in PayPal. Okay, this trade expired on that day, okay, which is where Amazon was trading right there, which is in the purple area. The purple area, and by the way, I didn't say PayPal was an iron condor. So ending up in the purple area when you do an iron condor equals full profit. So we collected the full profitability of this trade as well with PayPal, given the fact that the stock was trading inside the purple zone when the options expired. So that is it. Okay, so yes, you took it, Mark. Wonderful, perfect. I hope it was a great learning experience. Very convenient, by the way, to have a bunch of new stocks that were trading for very high price points, such as Amazon. But then they had a stock split. You don't see my video stream, guys, because I am sharing the video stream. So are you saying, Ahmed, that you don't see me? Will we have a session today? I am not sure what's happening here. Everyone, if you could, can you please confirm we're here? Okay, do you guys see the video stream? I am quite surprised at that message from Ahmed. Yeah, okay, great. So I guess that something is going on with Ahmed, maybe a problem on his end. Oh, yes. Yeah, thanks for those messages trying to help Ahmed. Thank you so much, my friends. You are the best. Thank you. So, okay, so no questions with Amazon, and PayPal, I guess, is also very clear. So it seems that, again, I'm not sure those values will be accurate since those options have expired. But it looks like we made $131 per contract on PayPal, and we made $183 per contract on Amazon. Okay, and what I was saying, I'm just gonna delete all of these because we don't need it anymore. But what I was saying is that stocks like Amazon, typically they got spies. Okay, those are stocks with great levels of implied volatility, very reactive to earnings approaching and all of those things. And for years actually, it's been difficult to be able to trade such stocks because those stocks they were very expensive from a dollar point of view. And again, expensive is a relative term, but at least during the sessions, I've been basically avoiding to use them because I always try to give opportunities that are okay for practice purposes, and because I assume that when a trader is in learning stages, you may use an account size which is lesser than when you're experienced, and therefore using stock which are $2,000 a share, $3,000 a share may add too much risk for those practice opportunities. And therefore for a long time there are certain stocks I never used because they were too high price points. But with many stock splits that happened recently, it's been very convenient both to make money from them and also for practice purposes, and Amazon has been a great example of that. So I like to make a note of this because when you build your watch lists, maybe if it's a long time you have not reviewed your watch lists, maybe you want to go back and take a look, because there are many stocks that used to be like $1,000, $800 per share, things like that are now trading at $100 per share, things like that. And that is probably very convenient for many of you, I would think. Okay, so wonderful, perfect, Ahmed. Wonderful. What matters is that we are all connected now, so thanks for confirming this. Cool. So Autodesk is the next one. Okay, and Autodesk, as you can see, expires on November 25. This is the end of our trade. This is also a double calendar. So we have work to do, very likely, we need to be rolling. So notice how Autodesk has been moving much higher, and then Autodesk has been dropping, and Autodesk is somewhere in the middle of the range. So that's going to be probably very convenient for us to do a proper roll. This together with the fact that implied volatility has been rising. Okay, as you can see, the graph is pointing up. So the implied volatility has been rising. And in that sense, we are currently making $225 per contract on this particular trade. And now we're going to be analyzing what if we do the roll. Okay, so we're talking about 215 and 190 as the strikes. November 4 is the expiration date for tomorrow. Therefore, I'm loading Autodesk, and I need to make sure I have November 4 and the next week, 11. Okay, 4 and 11 is what I need to check. And from a strike point of view, we said 190 and 215. Those are the strikes that have to do with this trade. 190, 215. Yes, I said it right. So let's take a look at the Greeks, and let's find out if Greeks are distorted or not. We're going to start with a 215 call on the front wick, where we have a theta of 35 cents. So it seems that we're going to make 35 cents a day times 1 day and a half. But notice how the bid and the ask is between 5 to 20 cents. So again, the calls are distorted, time to roll. And when it comes to the puts, the 190 put shows a premium of 75 to 50 cents. And the theta shows 91. So theoretically, we're supposed to make 91 cents a day, but the only premium available is less than that. So again, the Greeks are distorted, time to roll, both the put and the call. So no need to think about it. Just mechanically, I'm going to bring the trading platform, look at Autodesk. Oh, by the way, it seems that, yes, I don't have a put. Yes, I did not get filled in the last time I placed the order. Yes, so my bad. I guess I made a mistake, or now I remember what happened. If you recall, in the last session, I placed an order and I was not being filled during the session, even when I made it a market order, which this often happens with simulated accounts, which is what I'm using in the session. So that's why. So if you guys did it, you guys have a little bit of an extra premium in the trade, and therefore a little bit of an extra advantage. I didn't, so I don't have it. So I'm going to roll the call, okay, and I'm going to sell a new put, okay. So I'm going to do both. So by rolling the call from November 4 to November 11, still same strike to 15. I'm going to collect $127, okay? And that's going to reduce the risk of the trade. So I'm just going to go with it, okay? And Autodesk, when looking at the November 11, I also want to sell the 190 put, and that's going to collect another $240. Okay, so this is going to be selling a single, okay? Selling a single because I don't have it in the account, so I have nothing to roll, so I'm just going to sell a new one, okay? Okay, so I got the orders in. I just got filled on the single at $3. That's great. And for the one the role I'm trying to do, I'm not being filled, so I'm going to try to request a bit less. Yeah, let's say if I try 115, let's see if that works. So I'm asking for 115. The current mark is 125. Again, with patience, as you guys know, that's the way to do it, with patience. Okay, you may get it, but in my case, I don't have patience because I want to spend most of the time with new trades. So I'm dropping the price heavily, where if I get filled, I probably get a bad price. You probably get a better price than me, but it's okay. You know, I want to add as much practice as possible, so you guys know how to replicate all these steps and processes by yourself without me. So I'm just gonna go market. That's crazy. Never do a market order with options. Okay, I just got filled at 95 cents. Okay, got it. Perfect. So I got a very weak price, but it doesn't matter to me because all of this now is added to the account. Okay, so let's update our trade. Okay, so I'm going to use the compare spreads feature and copy the primary spread. And what happens to the primary spread now is that the November 4 became November 11. The November 4 became November 11. Okay, and with the 190, I already had 210. Well, now I just added another $3. So 210 becomes 510. Okay, that becomes 510. And on the call side, 455. That's what I got. And now we just added 95 cents on the call side. So 95 cents on the call side. That means that this now becomes 550. So if I click OK, we are now dealing with a trade that went from $785 of risk to $390 of risk. And if I maximize this so you have a greater view, again, we converted the blue risk graph into the orange risk graph, where you can see the risk is capped. Not only the risk is capped, but also the range is widened. And obviously, if volatility increases, which should happen towards earnings, okay, so the potential for profitability will be increasing. Okay, will be increasing. So the trade is good. The trade makes sense. I'm just gonna copy, go to my positions panel, and add it here as the next step in this massaging process that we do as we are moving towards the earnings date. Okay, so let me move back to the chart so you see where we're at. Earnings happening on November 22. Our expiration date, the final one, is November 25. So far, this earnings date has not been changed. If the date changes, we may close the trade ahead of time, but the earnings date is still the same. So all is good, all makes sense, and therefore, nothing else to be done. Just, let another week of time pass and be ready to roll again whenever we see distorted Greeks. I believe that you're quite used to this process. This is not the first time. So, I guess that maybe there are not too many questions about it, but if there is any question, please let me know. And the last trade I need to review before we go into new trades, it's Coca-Cola, KO. Okay, where we did let's call it an original application the other day. I mean, original is probably not the best term to define what we did, but anyway, so I got my notes on the other chart right here. Okay, so this is where we enter the trade. Okay, so from here the expectation was a continuation to the upside, but of course the S&P has turned. So okay, so Coca-Cola has turned too. No problem. If the S&P comes back up, Coca-Cola will come back up, and that's what we are playing. So in this trade, what we did was to buy a put spread 55.52, sell a cash secure put 52.5, and buy a call with the credit collected. So in other words, we are in a position where, as long as we don't go below 52.5, there's no risk. If it goes higher, we profit, and if it goes below 52.5, yeah, for sure, now we have risk, but also we collect a profit and premium to be able to get the shares of Coca-Cola put to us, and then we'll talk about what to do then. So the trade is behaving according to plan. I mean, it's been falling from that 59.6 to that area. It's been falling $1 something. So that's not ideal. Obviously, we would have preferred that it keeps just going. But of course, the S&P is doing some sort of a correction and some strong reaction to yesterday Fed report and blah blah blah. So that's what happens. Stocks move in wave, and this is an impulse, and this is now a corrective move, which, if everything is normal, it will be followed by another impulse, and that's what we are going to try to play, assuming this happens. And if it doesn't happen, we have a pretty wide room below price for price to fall without us really suffering much, because this could continue falling all the way to 52.5. And that's the only time where we need to act on this. Okay, so we can be quite relaxed here so far. So we're gonna just leave it alone, and we'll talk about this again next week. You didn't get it on Thursday or Friday, and you got filled on Monday at 9. Okay, good. Got you, Mark. Good, got you. Great that you were reviewing, analyzing, and making sure that you were on top of this. So that's fantastic. I love it. I love it, my friends. Cool. Okay, so time to find new trades. So I'm gonna get into the matrix. I will also take a sip of water, if that's okay. And we have 35 minutes of time in front of us for us to start, putting some trades together. And by the way, maybe this is a good time for me to share a thought with you guys, and you can share your opinion with me. It doesn't need to be now in the chat box, even though for sure, if you want, I'll certainly take it. But if you want to send me an email, that would also be another way to do it. The thought I'd like to share with you is that we are considering doing some changes on how we run our live sessions, where during the weekdays, instead of doing a full 1-hour session, some of you have commented in the past and also in the recent present that is difficult for you to attend a whole 1 hour and things like that. So we may end up with very condensed, compact type of sessions where basically we have, let's call it like trade ready to go. Instead of going through the whole process, which we have done many times, maybe we have some trades that are ready to go, and we just present those trades, and we keep the session super short, maybe 15 minutes, 30 minutes, something like that. And that way, we help you to practice more efficiently like that. And then from time to time, meeting online like we do now, but instead of 1 hour, maybe we make it 2 hours or something like that. And we can just spend as much time as needed to go over trade reviews or, anything. Questions, lectures, you name it, so we are considering making a change of that nature. I'd love to know what you think about that, and please feel free to let me know, if not now in the chat box, in an email. That would be good. Okay, but again, we think that would help better based on your feedback and some of your feedback. At the same time, I just want to make sure that there is no misinterpretation of what you guys are asking, and that whatever changes we apply are actually useful to you guys. So please let me know. Okay, thank you so much. Mark, there was a target of 52 to the downside. What is the target up on the side? Got you. Yeah, so the target, an easy one would be to project from the top that was created the other day, okay, project here. So 62 something would be certainly a target that makes a lot of sense for us to start taking profits on this trade. Also, keep in mind the expiration days that we used on Coca-Cola. I believe it was February. Okay, I believe it was February. So in that sense, depending on price action on the way up, you can reevaluate the target given the amount of time left until the expiration. Okay, cool. Yes, Mark, in one hand, 1 hour is too short. In the other hand, for many people that maybe in the office working and things like that, 1 hour is too long. And so maybe the idea is to make certain sessions, which are, reviews, coaching, all of that, to make it maybe 2 hours long. And then we can spend whatever time is needed with no rush, but also during the trading hours like now, instead of making those sessions to be too lengthy, to make them shorter, where the presentation of the trades would be faster as well, because the trades would be prepared. So it's not like I would need to go through all the steps I do with the matrix, because you've seen that millions of times already, isn't it? So I would just present the trades, and you will understand how the trades are structured, the rationale behind them, and these may help better to learn options and to practice. That's the idea. Yeah, Joe, and I get your point about posting the notes. Yeah, this is a very good point. Yes. I hear you. Yeah. So well, I won't spend time now explaining it. Okay. So we have more time for the trades, but yes, we are standardizing a process on how the trade setups will be presented on the screen, which imply also not only price points, but also some wording that explain what the trade is about. So I believe that this would satisfy your idea there, Joe. But yeah, certainly, thanks for sharing that thought. Anyway, so we're going to be looking for double calendars. Okay, volatility is not too high on the VIX, as we said. So I'd like to start my analysis looking at CIV mean less than 20. We know that if I don't find enough results here, I'll then move to CIV mean minus historic volatility below 2 standard deviations. And if I don't find anything here, I will go for the top decrease of volatility in the last 5 days. All of these will find you fairly cheap options, but I always start from the range, if you wish. So what are we looking for? Well, we're looking for cheap options, not related to any group. We are looking for options that are in the penny increment options list. We are looking for options that show neutrality on the daily time frame and neutrality on the weekly time frame. When it comes to earnings, we want 30 days or more. And then auto climate, we don't need anything related to auto climate because we want neutrality. Okay, so climate conditions are not useful here. We just want neutrality. Okay, so when I look for all of these, okay, we got no results. Okay, and again, not surprised because I'm being very strict with the volatility condition. Also, let's face it, with a huge push that we had in the last 2 days, gap down today and the very strong push yesterday going down after the Fed announcement. So obviously, finding neutrality is not going to be too easy. So I don't expect too many stock symbols to be found, which is good because we're looking for extreme opportunity, right? So I'm always delighted when my list is short, or in this case, I have no symbols. Okay, well, that's too short because then I cannot trade. But I'm going to go to the next one, which is below 2 standard deviations, and see if I get something. And now I got Roku. Okay. So again, always delighted to have this I'm trying to say so many things at the same time. This short list, because again, that means that we are looking for extremes, and extremes in a probability scenario kind of means high probability on our side. Okay, so here is the chart of Roku. This one is the one I'm looking for. Here's the chart of Roku, and in this case, it's not going to work too well really because the next earnings report is happening all the way in February. So we just had earnings take place, and that's why options are quite cheap on Roku. but really it's not like there is anything anytime soon that is going to spice up the value of the options. Okay, and by the way, the options is to be quite inflated, in the case of Roku, with the red line beyond the blue lines. Okay, so that is not something that makes me too happy. So let's take a look at the other way to look at cheap options, which is top percent decrease in the CIV mean in the last 5 days. And let's see now if using the other symbols, okay, we can find something which is okay. I'll start with Las Vegas Sands. Okay, let's take a look at Las Vegas Sands. So again, same story. We just got earnings, and by the way, I guess we all know that we got many earnings. We got many earnings being reported in recent times. So we may end up with that particular problem as we go through these few symbols they have, and then we need to change the strategy to be traded today because we may not have a setup that is acceptable. So we'll see. But Morgan Stanley, again, reporting earnings very late, all the way in, almost January 20. So January 20 is like 2 months plus from now. Just in my mind, it's just a bit too much. It's just a bit too much. It doesn't mean it's wrong. So far, if I didn't have any other setup, that's the one I would take. What about CF? So CF reporting earnings. CF is the same problem. Okay, earnings have been reported just a few days ago. What about ABBV? And that one, I believe, actually, the options are not that liquid. Yeah, and earnings have been reported at the time. So the only setup that really makes sense is Morgan Stanley. What I don't like that we need to focus on January 20. What I do like is that the earnings is happening on the 18th. So really, that's going to really help that January 20 expiration to pick up, lots of value throughout time. So that's a good positive. The only problem is it's a bit too far in my mind, and so many things could happen. And again, the statistical range we calculate today, which is the likely range for the trade, may end up not being so likely because we are shooting for very far in time. In any case, statistics are statistics and probabilities are probabilities, and we can see that we're using historic and implied volatility to project the range, and therefore, we are having a smart approach to calculating the range. So certainly no problem with doing it from that end, even though again, from a preference point of view, I prefer something a bit shorter in time. Okay, so we're gonna do it. Okay, so this is the range that we are talking about. Okay, this is the range that we are talking about. Of course, it's always important to find UFOs above and below those lines. So we got 54% UFOs there, and we have a UFO ending here. And on the bottom part, no UFOs there. So why is that? Is it because I need to load more data? Maybe. Yeah, so we're talking about, wow, that market has not been there since 2020. So maybe with a 55-minute time frame, I may not get enough data because I'm loading 10,000 bars. So let's try the 89-minute time frame. Okay, so with the 89-minute time frame, let's see, still nothing. What about the 144-minute time frame? Still nothing. What about the 233-minute time frame? 233 is kind of like half of a day. So we may start seeing UFOs now, and if we don't, then we'll use the daily time frame. Now, still no UFOs below the red line. So if I do daily, okay, we do have right here a UFO. Probability, as you can see on the top, is 56%. So certainly that UFO is valid for us to set the top end of the range. And on the upper part, I am slightly above this line because we were relying on a UFO found on the 55-minute time frame. Okay, so all good there in that sense. So now let's go ahead and do some math. Okay, so I'm just gonna get my calculator on the screen and let's do some math. The upper part of this range is 101.06, and the bottom part of this range is 63.42. So we are talking about a very wide range of $37, where if I divide that number by 3, that's 12.5, which added to 63.42, that is giving me 75, and I should have the 75 strike available. So 75 is somewhere here. Okay, and if we do the same calculation starting from the top, 101.06 it was, 101.06 is the top, 101.06 minus those $12.54, so that is 88. I'm not sure if we have 88. Okay, I'm not sure we have 88. Maybe we need to use 90. Maybe we have 87.5. We'll see. Let's see what's available on the option chain using January 20. So looking at the chain, no, I have not looked at the skew on this, Joe, and the reason why is just being pragmatic here. I only have one symbol I could use for the trade, so I cannot be picky. I mean, if you were to go to the extreme of being demanding on your trade setups, which there is nothing wrong with that, you may have a rule in your trading plan that says, look, I'm not taking the trade, okay, because I don't have a skew which is powerful enough. That's it, done. But at the same time, you know, it would certainly also be valid that when you need to enter a trade, you know, you just enter it with whatever is best available in the marketplace. And in this case, whatever is best available in the marketplace is Morgan Stanley is the only symbol that would make sense based on what we saw. So that's what I'm going to do, and that's the reason why I'm not looking at, you know, deeper analysis of the skew as I've done in prior sessions. So I'm going to look at November 11 and I'm going to look at January 20. And we need to look at the strikes which repeat. So we got 85, 87.5, and 90. But on the front wick, we don't have 87.5. We don't have 87.5. So then we will not be able to do a calendar. We're going to have to use 90, okay? Because 90 is available in both, okay? So 90 is going to be the strike for us to use. Let me go ahead and come back here so I can write it down. We're going to use buy the 90 call that expires in Jan 20, and this is 2023, and sell the 90 call that expires in front week. Okay, so that's the plan. So we're going to go with 90 because if we use 87.5, then we won't be able to find the 87.5 on the front wick. For the 75 put, that one I believe is no problem. So we're going to go with a 75 put that expires in January 20, 2023, and the 75 put using the front wick. Okay, so that's what we're doing with this particular trade. My friends, I'm just realizing I made a possible mistake here. My cone was not in the last date, so I'm so sorry about that, but I need to revisit the setup of this trade because notice how my range is totally different now, and that explains as well that in the other case I saw the red line above the blue lines. Sorry about that. I just noticed that my cone was not in the right place. So I need to restart, kind of. Let me do this. So the bottom part of the range will be here. The top part of the range will be here. Okay, so let's look at the 55-minute time frame and adjust the upper line, which is going to be here. Okay, and adjust the bottom line, which I'm going to have to do on the daily time frame, isn't it? Because we saw before that there was nothing on the intraday time frame. So let's adjust it, which is going to be below this guy. So this is going to make the range slightly narrower. Okay, this is going to make the range slightly narrower. So let me bring the calculator back and redo the math. Sorry about that one more time. So we are looking at 102.95 minus 66.88. This is divided by 3. This plus 66.88. It's 78.90. So instead of 75, we'll have to use 80. Okay, so we're going to do 80. Okay, and on the top part, 80 somewhere here. Okay, and on the top part, so the top part is the red line, let's call it 103 minus 12, that is 90. So we are still going to be using 90 here. Just need to move the line a bit more. Okay, so this is how we're going to approach it now that we know the right location, because I was making a little mistake there. So anyway, so 90, I'm going to be buying the 90 call using January 20 expiration. I just hold control on my keyboard and clicked on the ask column for the call. And now I scroll up to find the 90 call on the front week, which only pays 16 cents, very little, but is what it is. So 16. And then on the bottom part, we're going to use 80. So I'm going to click on the bid for the 80 put. And then I'm going to go back to the January 20 and find the 80 put and click on the ask. So this is my November 11, January 20 double calendar using 90 and 80 strikes with the calls and the puts. If I risk graph it, it looks like that. You have seen this before, isn't it? We are starting with an initial risk of 551. That's what this trade cost, and therefore this is the most you can lose. But remember, from now until January 20, every single week, we're going to be massaging and massaging and massaging and massaging. And ideally, as we're approaching earnings, we will then collect a profit based on an increase of implied volatility in the form of Vega profits. So that's the plan that we put in place when we do this kind of trade, and this is the setup. So I'm going to execute it in the Thinkorswim platform. Before I do, I'd love to confirm that all is clear. Maybe it's healthy if I zoom in case anyone would like to take a screenshot, or you want to make a note, or you want to review on the screen. So I'll do that while I take a sip, and you guys let me know on the chat box if there is any question before I execute this trade. Okay, and I want to double check something before I execute the trade, and especially it's because it's really catching my attention that the 90 call in November 11 only pays 16 cents. It's very little premium. You've seen me accept as little as 15 in past trades, so I could certainly take it. It's okay, but I am wondering that with 1 week and 1 day to go, we may be seeing a form of distorted Greeks already, and maybe that motivates me to start using November 18 instead of November 11. I want to assess that a bit better just in case, because again, this is a little bit of a different case compared to other cases that we have traded together before. And what I mean by different case is that we are using a very, very long-term expiration date with January 20. This is again a 2 months and a half double calendar. We've done, I would say, a month and a half, 2 months, maybe. I don't recall doing a 2 months and a half. I mean, it's not something I do often at all. Maybe a couple of times a year, and today maybe one of those days. So the trade makes sense, but again, because we are using a very long-term expiration date, maybe starting with the front week does not make sense unless you're closer to the call or something like that. So I want to double check that I am being paid something fair, and if not, I may move to the next week, and I'm gonna do this check, okay? And I don't see any question on the chat box, so I guess that it's all clear. So let me get rid of January 20. That's we already know. I want to add November 18, and also now I know my strikes, which is 80 and 90. So let's load 80 and 90 only and ignore the rest of the option chain. So if I look at the front week, okay, and I look at the 90 call, this 90 call is providing an implied volatility of 36, okay, with a theta of 4 cents, which 4 cents times 8, that is indeed more than 16. So the Greeks are being distorted on this end, and my natural action here would be to go for the next week. But, and there is a but, assuming there is no distorted Greeks on the next week, because the problem is that because we're using a long-term expiration date, then the range is very wide, and because we're using the front week, which expires very soon, then being that strike so far away, you get distorted Greeks so easy. So what I'm trying to say is that if we get distorted Greeks on the next week too, then I'm just going to leave it like that and just keep massaging every week, knowing that the range is wide and that's what it is. But if I don't get distorted Greeks on the next week and I do get on the front week, so then I'm going to start using November 18 from the beginning. Okay, hopefully this was not confusing. So let's take a look. On the next week, we got 4 cents. It's more or less the same theta. So 4 cents times 15. That is around $60. And notice how the bid and the ask show maximum 37. So notice how the Greeks are distorted on the front week, but also on the next week. And therefore, it's not like they are distorted. It's just the fact that that strike is quite far out of the money. Notice the probability of expiring in the money is only 13% or 7% on the front week. So very, very far away. And therefore, naturally, you will get distorted Greeks because, the probability of the price to go there is very low based on stats. And therefore, the pricing models, fall in that territory where while stats are stats, there is a moment in time where it doesn't really make sense. If it's okay for me to phrase it like that, I'm sure someone listening to me may want to kill me by saying that. And believe me, I love math and stats, being an engineer, and I certainly use them properly. But in an attempt to oversimplify or simplify what I'm trying to say, I just made that statement. Okay, so hopefully you guys took it the right way, and you're not gonna attack me like the math hater or something like that, because it's absolutely not the case. Anyway, so I'm just gonna go for it. I'm getting my 15 cents, which is my bare minimum. Not so happy about that, but it's what I get. So I'm just gonna go for it. Okay, cool. So let's go for it. I'm gonna bring in Thinkorswim. I'm gonna get into the trade tab. I'm gonna type Morgan Stanley. I'm gonna look for January 20, where we're gonna be buying the 90 call and buying the 80 put. And then I'm gonna move to November 11, which is the front week, where we're gonna be selling the 90 call and we're gonna be selling the 80 put. Okay, all of this generates a double diagonal strategy. Is identified like that by Thinkorswim. Is really a double calendar. That's what it really is. More than double diagonal, but that's how it's identified. The initial debit to be paid to get into this trade is 548. Real time is more, it's 548, so it's accurate. So I'm just gonna place the order and go for it, and let's see if I get filled. Morgan Stanley is fairly liquid, so I would expect to get filled fairly quickly. Maybe I need to reduce the cost, increase my bid price, 10 or 20 cents, and I'll get it. But normally you will get filled more or less easily. This is, again, a fairly liquid option chain. So that's what I'm going to do, just to save ourselves a little bit of time. I'm just gonna move it. In your case, just be patient. Maybe you can get a little bit of a better price than me. I'm just gonna go for 60 and see what happens. That's it. I got filled at 553. Okay, so that may be a good reference for you guys. 553, that's what I got. And now what I'm gonna do is I'm gonna document this so we can work on it on the following weeks and the following sessions. Okay, so 90 call, that is 280 and 340. So 280 and 340. And then we got 14 and 53. So 14 cents and 53 cents. This is our starting point, okay? So we are starting with this trade that cost us $553 and therefore has a risk of $553. Sorry, just created another graph. I wanted to copy. Here we go. And I'm just gonna paste it in the positions panel under Coca-Cola. That's it. So we have it. Okay, we have it. And again, now the play will be, to have this increase of implied volatility. And again, this is how these trades can profit so much more, so much better. And yeah, we'll be exposed to that possibility, my friends. It's a great moment to do this trade. Implied volatility has been going down. If we look at earnings, again, this is the pattern that we can see in almost every single stock. So notice the last time we got earnings, volatility went all the way to like 45. So if it goes from 32 to 45 sometime in the future, apart from all the premium that we're going to collect by rolling every week those options, with the increase of implied volatility, we're going to pick up more profitability on this trade. And that increase of volatility is very likely going to happen because earnings will be around that date. So yeah, so that's the trade that we just identified as the trade that we just planned and executed. And with 4 minutes to go, I would say the session is basically over. But before we say bye officially, I'd certainly like to make myself available for any final question or anything that you guys would like to discuss. For the ones of you coming in and joining us late or watching this recorded, remember next Monday's session with Joanne, as the market opens during 1 hour after the market open on Monday, in our website, you would just, let me bring it here. You would just go ahead, okay, tradewithufos.com. You just scroll down all the way to the bottom. And when you get all the way to the bottom, here you have the traders meetings, right? So you would just come in here. You have to log in, okay? You don't need to be a member of anything. Just have a username, which means that you almost once in your life did the free sign up. So you have a username on the website. So you log in with that username. And then when you come here, you just type your name and you're in the room, okay? And this meeting room is not moderated. I won't be there. So everybody just follow the rules that are here, which is common sense. And of course, you will be respectful to others, etc., etc. And have fun with Joanne and learn a lot and team up and don't be shy. And it's all about you guys sharing with each other and enriching each other all together, okay? So do not be shy, okay? It's not about you being there and being quiet. It's about you working with Joanne on developing yourself and all of you learning together. Cool. So Mark, I see your message there, Jose. So I'm not sure what else you meant to say, but I'm envisioning that you are probably typing something extra. So I'll just wait to see that message. In the meantime, everyone else, let me know as well if you have any question. Okay. You got filled at 545 on Morgan Stanley, 545, which is better than what I got myself, which is 553. So good job, Mark. And again, a great demonstration of being patient, letting the market to come to you instead of chasing. And we gotta be fine with options trading, because those 8 cents that Mark has saved between my fee and his fee, if you keep doing that every day of the year, as you trade options every day of the year, at the end of the year, that's 252 times the opportunity to shave some spread. That's a lot of money that you would leave on the table if you are not fine with the executions. Okay, so it's very important that you guys apply yourself and do not rush to get those options trades in your accounts. Okay, so great job, Mark, and everyone. Thanks for joining. I think that it's time now to say bye. We just hit the top of the hour. So again, it's been my pleasure, and I will see you soon. I will see you in the following sessions. I believe we have a top session over the weekend on Sunday. I believe I will see most of you there. And once I don't see you there, I'm counting on you to watch it recorded. Okay? Take care, everybody. Bye-bye, and see you soon. Ciao.